I want you to take a deep breath and look at the screen. What you're seeing right now, this sea of red, this sudden evaporation of wealth, isn't a market cycle. It's a regime change. For nearly 2 decades, the American investor has been addicted to one thing: cheap money. We've lived in a world where the Federal Reserve was the ultimate safety net. If the market tripped, the Fed caught it. If the economy slowed, they printed. But today, on February 2nd, 2026, the safety net just got ripped away. The nomination of Kevin Warsh as the next chair of the Federal Reserve has done more than just move price tickers. It has fundamentally broken the Fed put. For the first time since the great financial crisis, we are looking at a leader who doesn't believe in bailing out the market with liquidity. He believes in discipline. He believes in a lean balance sheet, and most importantly, he believes the era of easy gains for crypto and tech must end for the dollar to survive. If you are holding Bitcoin, Ethereum, or any growth stock, you are currently standing in the blast zone of the Warsh Effect. In the next 10 minutes, I'm going to show you exactly how the money printer is being dismantled, why the $80,000 Bitcoin support level just became a ceiling, and the 3-step strategy you must use to protect your family's wealth before the liquidity drain reaches its peak. This isn't just about a price crash, it's about the new rules of money. Let's dive in. To survive the next 12 months, you have to stop thinking about price and start thinking about liquidity. Most beginners think Bitcoin goes up because more people like it. That's only half true. Bitcoin goes up when there is excess US dollars looking for a home. Under Jerome Powell, the Fed was like a generous gardener. When the plants looked thirsty, he turned the faucet to full blast. This is what we call quantitative easing, or QE. By buying up government bonds, the Fed injected trillions into the banking system. That money had to go somewhere. It went into housing, it went into the S&P 500, and it poured into the crypto markets. Enter Kevin Warsh. Warsh isn't a gardener, he's an architect. He has been a vocal critic of the Fed's $7 trillion balance sheet for years. His philosophy, the Warsh Effect, is built on 3 terrifying pillars for the average crypto trader. Balance sheet normalization. He doesn't just want to stop printing, he wants to take the money back. This is quantitative tightening on steroids. When the Fed shrinks its balance sheet, it is effectively sucking the oxygen out of the room. Without that oxygen, risk-on assets like Bitcoin struggle to stay inflated. The anti-inflation hawk. While the market was hoping for aggressive rate cuts in 2026 to save the housing market, Warsh has signaled that he prioritizes the integrity of the dollar over the enthusiasm of the market. This means interest rates may stay higher than anyone predicted. Orthodox finance. Warsh is a hard money guy. He believes assets should have intrinsic value or generate cash flow. To him, a meme coin or a speculative NFT isn't an investment, it's a systemic risk. Why did Bitcoin drop from $92,000 to $79,000 the moment his nomination gained steam? Because the smart money, the hedge funds, and the institutional whales realized the faucet is being turned off. They know that in a Warsh-led Fed, there is no one coming to save the market if it drops another 20%. This is the liquidity drain. Imagine a swimming pool where the drain has been opened. The water doesn't disappear all at once. It recedes slowly from the edges first. The edges of the financial market are crypto and small-cap stocks. That's where the pain starts. If you're waiting for a V-shaped recovery, you're playing by 2021 rules. In 2026, we're playing by Warsh's rules. I want you to take a second to talk to you, not as an analyst, but as a person who knows what it feels like to see your hard-earned savings fluctuate wildly because of a decision made by a few people in a room in Washington, D.C. It feels unfair, doesn't it? You did everything right. You studied the charts, you listened to the podcasts, you DCA'd into your positions, and you believed in the long-term vision of a decentralized future. And then a change in leadership at the Fed feels like it's stealing your progress. The emotional toll of a macro pivot is heavy. It leads to FUD, fear, uncertainty, and doubt, but more dangerously, it leads to apathy. You might be tempted to just close the app, delete your accounts, and say, "I'm done with investing." Don't. The reason most people lose money in the Warsh era isn't because the market goes down, it's because they lose their perspective. History shows us that when the Fed pivots to a tight money policy, the garbage gets cleared out. The projects with no utility, the companies with no earnings, and the get-rich-quick schemes all evaporate. But what stays? Quality. In 1980, when Paul Volcker, the most famous Fed hawk in history, crushed the market to save the dollar, it was painful. People burned effigies of him, but that pain laid the foundation for the greatest bull market in American history. We are in the cleansing phase. If you can survive the emotional volatility of the next 6 months, you will find yourself holding assets that are battle-tested. The Warsh Effect is a filter. It filters out the gamblers and rewards the investors. If you're feeling anxious, it's because you're focusing on the price of today. I want you to start focusing on the opportunity of tomorrow. This isn't the end of crypto, it's the professionalization of crypto. It's moving from the Wild West to the global reserve, and that transition is never peaceful. All right, enough talk. Let's get practical. How do you actually protect your portfolio from the Warsh liquidity drain? Here is your 3-step playbook for the remainder of 2026. Step 1. Defend the floor. In the crypto world, support levels are psychological battlegrounds. Right now, the $74,500 to $76,000 range for Bitcoin is the Warsh floor. This represents the price before the massive 2025 liquidity pump. If Bitcoin holds this level, we are in a healthy correction. If we break below it, the Fed has successfully drained enough liquidity to trigger a recessionary trade. Watch this level daily. Do not buy falling knives until you see stability here. Step 2. The Great RWA Migration. If Kevin Warsh wants discipline and yield, that is exactly where you should put your money. We are seeing a massive rotation out of altcoins and into real-world assets. These are crypto tokens backed by US treasuries, gold, or real estate. Why? Because when liquidity is tight, investors crave certainty. Projects like BlackRock's BUIDL or tokenized housing platforms are going to outperform purely digital assets in a high-interest rate environment. Follow the yield, not the hype. Step 3. Build your dry powder fortress. The biggest mistake you can make right now is being 100% invested. In a Warsh-led economy, cash is a strategic asset. I am personally keeping 20% of my portfolio in high-yield stablecoins or a US Treasury money market fund. Why? Because when the Warsh effect causes an overcorrection, and it will, you want to be the one with the cash to buy the bottom while everyone else is forced to sell. Step 4. Real estate reassessment. For my homeowners and real estate investors, the Fed pivot means mortgage rates are going to stay sticky around 6%. If you were waiting for 3% to come back, stop waiting. The new normal is higher for longer. Focus on cash flow properties rather than appreciation plays. In the Warsh era, a house that pays you $500 a month in rent is worth more than a house that might go up 10% in value. The Warsh effect is a wake-up call. The days of closing your eyes and winning are over, but for the disciplined investor, this is where the real wealth is made. If you want to stay ahead of the Fed and protect your future, hit that subscribe button. I'll be here every week breaking down the data. Drop a comment below. Are you selling, holding, or buying the Warsh dip? Let's talk about it. I'll see you in the next one.